Caplin Point is one such case in point. The stock tracker reveals that there's been a significant drop in the stock since the results were announced. There are concerns over margins and high receivables as well. The stock, by the way, is down a good 30% from its top. So let's bring on board the chairman of Caplin Point Laboratories, Mr. C.C. Paarthipan, joins us on the show right now. Mr. Paarthipan, morning. There's been an increase in the receivables. Have you extended into newer geographies and new businesses line that is forced to increase credit line to customers?
Okay. Now, first let me address the battle of perception that created a concern or an apprehension with one section of shareholders with regard to our receivables, which is credit sales in our annual report of 16-17. This credit sale is a conscious business decision to convert one portion of our generic business into branded generics to ensure higher profitability, which is already visible in our annual report. There is an increase of PAT by 51%. Number two, as we enter into bigger geographies of South America, credit lines to some customers becomes inevitable in the initial stages, which we are sure of changing it as cash shares maybe in 3 to 4 years due to the following reasons. Reason A, we are one of the first company, especially the pharmaceutical company, which has introduced a healthcare portal to automate the clinics and pharmacies free of cost to get the data. Our plain generic business will become a data-driven business in due course. We are also sure that the information in the form of our product sales to our customer will come to our portal that makes our job easy to collect the receivables from the distributors and chemists. The second issue is that we are one of the few companies which has registered maximum products in Central America, Caribbean and Southern America in the region of 100 to 400 products in various countries, and this created a customer dependence on our company. Further, the third one is we have created an end-to-end business model where we are assured quality, affordable prices, variety, novelty and logistic advantage to our customer. Hence, we don't consider this credit sales as a credit risk.
Can you give me a sense of what is happening to injectable prices in the US market? Because, what we understand from other generic players is that there is a price erosion which has happened across categories, whether it is ANDAs or APIs. Is the injectable market any different?
It's true there is a price erosion in US market. But again, if you look at it, what is considered as a price erosion to the top 2-3 companies have also become an advantage to 1 or 2 Indian companies where they have increased their business and profits. Which means over a period of time, if we can increase the number of dossiers, that itself will become an advantage. What is actually a price erosion to a company where the overheads are very high may not be a price erosion to a company of our size. In addition to that, 40% of our business goes to North America, whereas 4% of our export goes to South America, where we are one of the dominant players. Hence, our main focus is on South American market, where we are expanding from smaller geographies to bigger geographies.
All right, Mr. Paarthipan, appreciate your time and thank you for joining us.